All right, going in with the legal structure of business. There are 4 different ways in which you can structure your business. I'm going to touch on each of them, lay the foundation for all of them, and hopefully by the end of this, you'll have a clearer understanding of which one you are and why. This is in no way, shape, or form going to be a thorough, in-depth explanation of them. However, this will paint a clearer picture on what each of them entails. The first thing I want to get out the way though is, am I a business? Most people associate businesses with stores or having a physical presence, and that is not the case. Do you offer a product or a service? It does not matter what it is. Are you earning income? Are you generating revenue from this product or this service? Are you selling hot plates out your kitchen window? Are you doing nails in your dorm room? Are you doing hair in your basement? If the answer is yes, then the IRS says, yes, you are a business. They do not care how you're making money. They just care that you are making money, and you will be taxed accordingly because they want in. Now, how you are taxed, though, how you are taxed depends on the structure that you choose. Going into the first structure, which is the default structure, we have a sole proprietorship. Once you start doing business and you do not register this business with the state, you're just doing whatever it is you're doing that's making you money, you automatically have a sole proprietorship. You are the sole owner in a sole proprietorship. It is just you. You are solo dolo. And with that means that you 100% bear all liability. You assume all of the risk. There is no separation between you and your business and you. You are it. It is you. Y'all are one. Now, with that, that also means that you pay pass-through taxes. All pass-through taxes are, or all it means really, is that the income you generated from your business dealings passes through the business and you pay taxes on it with your personal income. To do this, you will file a 1040 Schedule C, which is profit or loss from a business. While there are other forms that you can file, and I'll touch on them in a tax video later on down the line, this Schedule C will more than likely be your best friend. Now, there's an E if you have rental property, or an F if you're a farmer or a fisher. But this Schedule C, you and it and you will be the best of buddies come tax time. Going on to the next filing status, we have a partnership. Very similar to a sole proprietorship, except surprise, surprise, now you have partners. That is one of the only differences. You have multiple partners in a partnership, which means the ownership is split amongst you all as percentages. In splitting the ownership up into percentages, this means you also split your liability. With a partnership, you are still personally liable for all of the debt incurred with your business. However, you're not 100% responsible any longer because you have those partners. With a partnership, you also pay pass-through taxes, meaning once again the income from the business passes through the business and goes on your personal tax return. Now, if you're thinking, well, if I have multiple partners, how am I supposed to, say what income I received and what income my partner received? This is where the Form K-1 comes into play. A Form K-1 details what you as a partner specifically earn from the business. So if you have 30% ownership in this partnership, you are 30% personally responsible for the liability, and on your Form K-1, you will report 30% of what the partnership earned. Now, piggybacking off of that, the entity itself, the partnership, has its own tax return. It's a Form 1065, and I will show you how that looks later on in the video, but the Form 1065 is for the business. This is going to detail 100% what the business made and what the business spent. Now, for each partner, though, each partner gets that Form K-1 so that they can specify what portion of the partnership income they received. So however many partners you have, that is how many K-1s you have. You only have one Form 1065 for your business. One 1065, however many partners you have, that is how many K-1s will be filed. Moving on to the most common and the most familiar business structure, we are now at the LLC, the Limited Liability Company. Now we're on the good stuff because now you have liability protection, which means your business is separate from you. Your personal debt is not related to your business debt, and your business debt cannot impact your personal assets. This is the ideal structure once you really get into the swing of your business, once you really establish yourself as practicing or performing or selling or whatever it is you're doing. You will want that liability protection so that people cannot come after your personal assets. Now we are members. We were owners, we were partners. Now we are members of the LLC. What is unique about an LLC, though, it is not a tax entity according to the IRS. The IRS does not have any specific tax structure for an LLC, which means when you register your LLC with the state, you also have to choose how you want your LLC taxed. Do not be confused and think this means if you tax your LLC as a sole proprietorship, you are now a sole proprietorship. That's not what that means. You are still a limited liability company. However, for tax purposes, you are asking the IRS to tax your LLC as a single member or sole proprietor LLC. Now, you can choose between a sole proprietorship LLC if you're the only person who owns it, you're the only one kind of operating it, and you just wanted to establish your business as an LLC for that protection. You would be a single member LLC, and your business would be considered a disregarded entity, meaning that even though this business is separate from you personally, you still want the income included on your personal income. You can choose to have it taxed as a partnership as well, or as a corporation, which we will talk about in just a second. So with corporations, we have two different types of corporations. We have an S Corp and a C Corp. With the S Corp corporation, you must be a domestic business. You can have up to 100 allowable shareholders. The IRS restricts what kind of shareholders can be shareholders in an S corporation, and we've moved from the term members to shareholders. Shareholders are the owners of a corporation. Most people know that corporations have stock. With an S Corp, you can only have one class of stock. You cannot be an ineligible corporation if you plan on registering as an S Corporation. The IRS has a list of practices and businesses that cannot register as an S Corporation. An S Corporation also pays pass-through taxes, meaning the income is passed from the business on to each individual shareholder. The corporations file Form 1120, and corporations must also adhere to a specific set of standards and rules, including they must have a board of directors. Similarities and differences with the S Corp and the C Corp. The C Corp does not have to be a domestic corporation. You're free to go ahead and, establish your business overseas and whatnot. You can have an unlimited amount of shareholders, multiple classes of stock. You are double taxed with a C Corporation, though. This means the income is taxed twice. Once on the business level and once on the dividend level. So your business income is taxed at the corporate level, and then when the shareholders are paid dividends. Dividends are the payments made by the board of directors to the shareholders that are their payments from the business income. So that business income is taxed at the corporate rate, and then the dividends are taxed with the shareholders' income tax returns as well. And then similar to the S Corp, the C Corp also files Form 1120 and must establish a set of standards and rules, including having a board of directors. Going on to these forms that I talked about earlier, here's that Schedule C for sole proprietors and single member LLCs. As you can see, it has some pretty basic and standard information, business information, your accounting information. I will be releasing a video about bookkeeping for the self-employed and how to track your income and expenses so that you can kind of just easily transfer over those numbers onto this form without having to pay for a professional service or a professional software. Partnerships, we have that 1065 for the business itself, and then we have that Form K1 that's given to each partner to file with their own personal tax return that details what percentage of the income from the 1065 went specifically to them. The corporations, we have the 1120s and then the 1120-S to specify that's the 1120 for the S corporation. As you can see, they look pretty similar to each other with a few minor differences, but essentially the gist is the same. What's the business? How much did you make? How much did you spend? Like the partnership, because it is a pass-through tax entity and the income is passed through the business to the shareholders to report on their own personal tax income. Each shareholder of an S corporation must also get a Schedule K-1 to report what percentage of the S corporation earnings went specifically to them. Now, this little chart, just to briefly summarize what we talked about, sole proprietorships do not have to register with the state. The individual owner holds full control and they are personally 100% liable for their business and business practices. The business is considered an extension of the owner themselves, so the owner pays taxes with their other income. They are not double taxed, but they will be paying self-employment tax, especially if this is your only source of income. Your self-employment tax are your FICA taxes. So if you have a job and your employer is already withholding taxes from your income, you can ask them to increase how much they withhold so that you're not hit with as much of a self-employment tax burden on your other supplemental income. However, if this is your only source of income, you will be paying self-employment taxes using the form 1040 ES and SE. I'll detail that in the tax video later. You can draw directly from the business earnings. You have pass-through taxes and you file 1040s. Going with the partnership, you do have to file a partnership with the state. Each partner has an agreed upon percentage or portion of the business, which means each partner has an agreed upon percentage of portion of the liability and debt. The business is similar to the sole proprietorship, considered an extension of the owner, which means they are personally responsible for the debt and they pay taxes with their personal income. The partnership is not double taxed. However, you will be paying self-employment taxes. Something that's just common if you are in business for yourself. You're going to have to pay these taxes. You can draw directly from the business income. It's just something that has to be reported on the tax return, and you do pay pass-through taxes. For your business income, you will file one form 1065 for the business itself, and then each partner will file a form 1040K1. LLC, you file the LLC with the state. You are now a member and you can set up the ownership structure as you choose. There's that veil of protection between you and your business. So now you are no longer personally liable for your business debts. Now, everything related to taxes depends on how you choose to have your LLC taxed as. If you choose to be a sole proprietorship LLC or a single member LLC, you go with this first column. If you choose to be a LLP, a limited liability partnership, you go with this second column. If you choose to be a LLC corporation, you go with this last column. Corporation. Corporations must also file with the state. However, corporations are owned by shareholders and operated by a board of directors. Keep in mind that you have to adhere to a specific set of rules and standards if you are registering your business as a corporation. Also remember that if you're an LLC getting taxed as a corporation, this is completely different. You are still an LLC. You're just being taxed as a corporation. The S corporation business income is passed through and paid taxes on by shareholders, and the C corporation is the double tax. The entity is taxed at the business rate, and then the dividends are taxed with the shareholders' income tax return. As far as self-employment tax, if you are a shareholder and you're also an employee of the business, so let's say you're the CEO or whatnot, and you get a salary from the business, then ultimately you're going to have to pay taxes on your salary. You're going to have to pay taxes regardless. Shareholders receive dividends payable by the board of directors. That is how shareholders get paid from corporations. And if they are involved in the operations, they receive an agreed upon salary, and all of this is reported on the tax returns. As corporations do have pass-through taxes, but C corporations do not. We're going with that double tax idea. And then for the income tax forms, both corporations file 1120s, 1120-S for the S corporation, and then each shareholder in an S corporation will file a form 1040K1. All right, hopefully that was able to clear up any or some confusion about the different types of business structures, and I will see you again shortly on my next video.